Infrastructure is an asset class typically characterized by its stable cash flows, low correlations to traditional asset classes, and inflation hedging properties. But with a number of potential disruptions ahead from lower growth, higher interest rates, and elevated inflation, does the value proposition still hold? And if so, how should investors allocate to this asset class? My name is Anu Rajakumar, and today I'll be diving deeper into this topic with our head of infrastructure, Michael McCarthy, who's going to share more about the opportunity set ahead for this important investment category. Mike, thank you for coming on the show.
Thanks, Anu. Excited to be here.
So, Mike, let's start off with a little bit of context around this investment space. Talk us through the evolution of private infrastructure investing and how it's informed today's opportunity set.
Sure. The first dedicated infrastructure funds were actually set up in the mid-90s, and they originated from Australia. Local pension funds there were both early investors, adopters, and sponsors. They sort of banded together to promote such funds and took them more globally to other investors in the early 2000s. So this also corresponded with a burst in the technology, media, and telecom bubble, the dot-com bubble. And it sort of allowed these pension and investment funds to reconsider their traditional stock, bond, and real estate allocations and consider new ways to diversify. This was a history of reevaluation that I see repeating itself, where asset allocations are being reevaluated for greater diversification. And it's specifically happening at a time when our infrastructure investment needs are very, very clear.
Absolutely. And, speaking to investors, this is something that is front and center. How do we find diversifiers and how we're going to restructure our asset allocation going into this new environment? You mentioned just at the end there, at a time when our infrastructure investment needs are very clear. So let's dig into that. Tell us about what are the infrastructure needs and what are the key themes that you are specifically focused on right now?
Sure. That reference is really to a once-in-a-generation energy transition. That is probably the largest thematic in the market at the moment. We really have a need to decarbonize our electric grid and indeed our economies. And countries and governments have been doing a good job lately of legislating towards that, but we need broader adoption. So that is a major investment opportunity and theme. The other major theme that we talk about is digitalization. This is sort of 5G, the Internet of Things, cloud computing, big data. There's a real opportunity set. This data goes over the airwaves to towers, through fiber connectivity, and into data centers. And all of that is privately invested in and really requires investment to keep up with our pace of data generation. I mean, the global mobile data traffic has grown 20% over the last 5 years from machine to machines. And just organically developed data is projected to grow at 28% over the next 5 years. And perhaps the stat I like best here is that we as users have spent more and more time on social media sites. In 2012, we were only spending 90 minutes a day, and now it's up over 2.5 hours.
Wow. That's why I cap my usage of social media every day to 20 minutes. So I get that guilty reminder.
Although podcasts are great.
Podcasts, totally different. So that's education.
And then the two other themes that we like to think about, one, are supply chain and logistics. So throughout the pandemic, we really saw the impact of strained supply chains and the rising costs in shipping goods. While that's come down from its peak, at one point it was sort of pre-pandemic, it cost, for instance, $1,300 approximately to ship a container from China to the U.S. West Coast. That went almost as high as $20,000. And today it's between $2,000 and $3,000. So we're still 2 to 3 times where we should be, but obviously we've seen how some duress can really stress the supply chain. So the shift in global logistics will require further investment. And the last one is urbanization. And this is really a trend of deferred maintenance and underinvestment in cities. And in particular, a shift in work from home and travel patterns, and even where people are choosing to live as a result of sort of work from home policies and the pandemic. People are moving away from some of the biggest cities and into mid-tier cities. And when you add those people up in those mid-tier cities who haven't had investment in their infrastructure, there's a huge need.
Yeah, I think on that last theme that you mentioned, the urbanization one, which captures public transportation and tollways, highways, et cetera, I think that's what people often associate with infrastructure. And, I believe there's a general perception that governments typically fund those kinds of projects, if you will. But I guess my question for you is, so how do private investors partner with these public bodies, the governments in this area to accelerate progress? And how does that, I think you probably focus on the US, but how does that also happen globally?
Sure, yeah. You know what? Everyone has a role to play. And I think that it's a different answer in each jurisdiction, but there are some common themes. So historically and traditionally, infrastructure has been thought of as a government domain. something funded by general tax revenues, as you pointed out. That has shifted over time for various reasons. Today in the U.S., for instance, we regulate private investment in key sectors such as electricity distribution or utility distribution. And we've encouraged investment in sort of generation assets to sort of promote efficiency. And on the digital theme, that's really been the private domain. But certainly, again, governments can play a role by providing grants or subsidies where needed to sort of allow everyone to participate. And they do that effectively because they can subsidize the cost where it's needed to reach rural markets, for instance, with high-speed fiber. And I think, frankly, the opportunity set in those two digitalization themes and energy transition themes will continue to grow with the predominance of private capital. Where governments have been more dominant is sort of in the urbanization space. And I think that there's lessons to be learned in terms of how they've approached their capital plans. And we've seen some sort of initiatives in that regard. Public-private partnerships have come to the fore in various forms over the last couple of decades, and we'll continue to see that. And lastly, I think independent stakeholders have really contributed to the dialogue. The Association for Civil Engineers in the U.S., for instance, has been putting out, since about 1996, their report card on the state of infrastructure in the U.S. And that's gotten lots of media attention. I think it's made folks aware of the infrastructure assets that we have, even when they're unseen. And it's called out the need for investment. They've been giving a D ranking up until this.
I was going to ask, what's the grade? Oh, gosh, a D. All right.
Exactly, until the very last report card, which is now a C.
All right, that's improvement.
Indeed.
That's good. Progress. And what about overseas? Any comments about any other countries, Europe or other regions?
Absolutely. I think in Europe, they have led the way, in particular on the energy transition. And they have legislated prior to the U.S., although we've introduced some great legislation just this year to sort of tackle that challenge. And that challenge continues outside developed markets as well. For instance, in Australia, even though they are a G20 nation, 60% of their power grid is supplied by coal plants. I mean, that is a phenomenal amount of coal production in one country. And similarly, in the rest of the world, some of the production of energy is weighted towards emitting carbon-based fuels. The last item I'd point to is really this burgeoning need. And the G20 estimates that the world will need $94 trillion of investment through 2040 just to support current growth. And sources of investment or sources of capital to support that estimate really leave a $15 trillion investment gap. So there's currently a huge opportunity.
Okay, great. $15 trillion investment gap. That is big. You mentioned energy transition a lot here, which aligns well with ESG, which is a very popular topic on our episodes. Anything else that you want our listeners to know as it relates to ESG within infrastructure?
ESG is definitely top of mind for infrastructure investors. One consideration that I think is important for folks to understand is that we do consider all of the E, the S, and the G. And in particular, we have a mindset that we have to maintain the social license to operate. As an owner or caretaker of a key community asset, you want to be sure that everyone has a voice and you're considering all those stakeholders. And we run our ESG screens very carefully, working with our management teams and our partners, and indeed all stakeholders who need a voice.
Okay, great. Well, thank you very much for that. Just as we wrap up here, Michael, I just wanted to ask you, this is infrastructure is a little bit of a newer asset class, as you mentioned at the beginning of this episode. What are some misconceptions that investors might have about this asset class?
One misconception I would say that is commonly held is around liquidity. And I think that because of the essential long life assets that are generally held by infrastructure investors and the fact that it's private equity oriented, folks may rightly assume that they're relatively illiquid, but that is changing. You may have a 50-year life power plant or toll road or beyond, and certainly there is an expectation that the investors will have a long-term view, but through the growth of the industry and the maturity of the landscape of investors, we're seeing more and more liquidity option being provided either at a midlife stage or through different vehicles and innovations. So that's definitely, I think, where we're headed next. But I think the biggest misconception is that infrastructure is still predominantly the jurisdiction of governments. We work with governments as a partner, and they are our regulators often. But the pendulum has swung, I would say, to a private capital-dominated industry in those major themes that we talked about, energy and communication, and supply chain and logistics to a certain degree.
Excellent. Thank you very much. Michael, I like to end every episode with a bonus question, and this one will be just the same. So Halloween is right around the corner. So my question for you is, what is your favorite candy?
Oh, Yeah, definitely red licorice.
Red licorice, really?
Yeah.
You're one of those.
I, as a child, was told I was allergic to chocolate to keep me away from it. So as a result, it's red licorice.
Oh, I'm going to write that one down for my 2 young children. That is a good way to wean them off the candy. All right, Michael, this conversation has been very helpful. Lots of insights. I just want to remind our listeners of the 4 key themes that you had mentioned earlier in the episode. Energy transition was a big one. Digitalization, supply chain and logistics, and urbanization. And you had some really, really interesting facts, I think, in each of those subtopics. Hopefully our listeners can walk away with some interesting food for thought as we continue on in this transitional state of the world, where I think infrastructure investing will play a big role. So thank you again for being part of the show.
Thank you. It's been a pleasure.
And to our listeners, if you've liked what you've heard today on Disruptive Forces, you can subscribe to the show via Apple Podcasts, Google Podcast, or Spotify, or you can visit our website, www.nb.com/disruptiveforces, for previous episodes, as well as more information about our firm and offerings.
This podcast contains general market commentary, general investment education, and general information about Neuberger Berman. It is for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. This communication is not directed at any investor or category of investors, and should not be regarded as investment advice or a suggestion to engage in or refrain from any investment-related course of action. All information is current as of the date of recording, and is subject to change without notice. Any views or opinions expressed may not reflect those of the firm as a whole. This material may include estimates, outlooks, projections, and other forward-looking statements. Due to a variety of factors, actual events or market behavior may differ significantly from any views expressed. Please refer to the disclosures contained in the episode notes and episode details, which are an important part of this communication. Investing entails risks, including the possible loss of principal. Past performance is no guarantee of future results.